Hello, I'm John Kennedy and I'm one of the advisory partners based in our Cape Town office. My brief is to share with you a couple of emotions that you need to consider and be aware of when you're making investment decisions. I think it's the most important just to acknowledge that we're not logical and rational all the time and that we do make emotional decisions. And just recognizing that there is emotion at play will go a long way to achieving the right investment portfolio for you. Like I said, emotion overrides logic, and I think in South Africa we go through this theme the whole time of worry on and worry off. There are things that concern us and we're negative, and then there's times that we're very positive and exuberant. I think the first thing that you've got to consider when investing capital is that we typically feel safe in numbers. We typically want to follow what other people are doing. So if prices are going up, we're happy to participate with everybody, and if prices are going down in investments, we typically want to stay away. We feel comfort in the herd, and it's the one area we need to be wary about on an ongoing basis. The second point I want you to consider is that we all make money decisions all the time, whether we realize it or not. And regret plays a big part of making investment decisions. Any time that you've made an investment historically, which you've come to regret because it's made a loss or didn't work out as planned, you typically don't want to make the same investment decision again. And that is a big concern for us as investors, because often that investment which didn't work out historically, i.e. buying equities when they were high and then they went low, doesn't necessarily mean that you shouldn't be looking at the equity market again. I use a simple example. It's like going to a restaurant and having prawns, and that night you have an absolute gut's ache. Does that mean that in a week's time you don't have prawns again? For many people they won't, but often that next meal might be the best prawn meal that you'll have. The third point I want to bring to your attention is that we are pattern-seeking creatures. We're typically wired for survival, so we typically like to follow patterns. If we've seen something that's worked out before, that's what we typically follow. And that's a risk to us, because if we assume something will forever go up, and we allow our emotion to cloud our judgment, inevitably it will revert back to the mean and it will go down. Similarly, if we assume something will always go down, it's not always going to go down, it will revert and will go up again. I think the point that I'm trying to make here is just be wary of trying to base short-term, recent past and extrapolate that into the future. The fourth point I want to share with you is the insight that we've picked up over time, and that people are typically overconfident. When they've had significant success in their personal lives, whether it's been in their career or their business, and now they wear the investor hat, they try and take that overconfidence into investing. And overconfidence can be an incredibly destructive emotion. We think we're bulletproof until we've been shot. So we think we can make money in markets until the market corrects and we learn a horrible lesson. The one caution, the one emotion that I would always put high up there is try not to be overconfident when it comes to be investing. And that speaks to things like making sure that you diversify and that you think objectively about allocating capital. The fifth point I want to bring to your attention is worrying about the packaging, or being aware of the packaging. The financial services industry has an incredible way of complicating investing and bringing jargon to the fore. I think the one thing that you've got to be wary about is that there are very strong marketing teams that sugarcoat things, and that often what attracts your attention doesn't always make sense to you. Be very wary of being caught out in this regard. Be wary that that emotion doesn't always make good investment decisions for you. It's where the advisor comes to the fore in being the voice of reason, just being aware that the packaging doesn't always lend itself to what's underlying or what the underlying investment actually is. Folks, so just in closing, I think just a recap of what I've mentioned, I think just acknowledge that emotion often overrides logic. So when you're wearing your investor hat, be very cautious of being greedy at times or fearful at times. Be cautious of being overconfident. Make sure that you understand why the herd is moving in a certain direction, and don't just think that there is safety in the crowd. Be wary of the decisions that you've made historically which you've come to regret, and understand why you've regretted them and what you can do to fix them. And lastly, just be wary that the sugarcoating or the packaging of the industry often doesn't tell you exactly what you're buying into. It's important to understand what investments you're making and why you're making those investments and what they're there for. If you get those emotions right and you understand those things right, in allocating capital, you'll make a lot healthier, crisper and more objective decisions when you do make money decisions. Thank you very much for your time. I appreciate it.